Hey there, happy Friday. On today's edition of The Final Bar, we're going to debrief on one of the worst market weeks since 2008. This has been destructive by any measure. We're going to take a step back, and in our Wrap the Week segment, we're going to look at what this week means relative to the long-term trends. Now we've got a good frame of reference to look back to the left on the charts and see what makes sense and what doesn't. Gold down as a safe haven, bonds up, energy at the top of the list. So we'll debrief all of those signals and more. Ladies and gentlemen, this is The Final Bar. Hey everyone, welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close. Look at the performance of the markets today, try to connect it to the long-term trend, and no better time than this week to wrap the week, which is what we're going to do today. Really try to put this week into proper context. And I would say the word context is something we all need a lot of right now, trying to get our heads around what has happened here. We've talked for so long about this unrelenting uptrend, this continuing move higher that in 1 week has unwrapped 5 months of gains. So thinking about how to put that into context, trying to put some sort of historical reference, that's what we're going to attempt to do today. So I hope we're able to do that together. We're also going to answer some of your questions from the Final Bar Mailbag. We had a lot of questions given the action this week, so look forward to getting to some of them very, very shortly. I want to talk to you about the schedule coming up here on the Final Bar and also on StockCharts TV. So on Monday, March 2nd, we'll be featuring Fred Meisner on our other show, Behind the Charts. Sat down with Fred recently in Atlanta. Has some great stories about learning technical analysis from some of the industry greats before him. After that, on March 3rd, we'll have Scott Smith from Briefing.com. March 4th, Jeff Weiss, who's a longtime technical analyst, a mentor of mine and many others, worked at some of the big shops going back over time on Wall Street. Should be fun to hear from him. Then the Final Bar is actually going on the road. We're going to have some guest hosts on the Final Bar. Tom Boley, Aaron Swenlin, also Julius DeKempner are going to help us debrief on the markets to complement some of the things we'll be producing ahead of time to give you some information about what's happening. We are going to be speaking at the Traders Expo in New York. So if you're going to be attending that, hope we'll see you there. I'd love to meet you after the session. Make sure you look at my session while we're there. And we'll also be recording a lot of fantastic interviews with some of the other speakers during the show. So a lot of good things coming up here on StockCharts TV. I want to get right to our market recap. So this week has certainly been interesting. And when I'm looking at my Wrap the Week segment, I'll be honest, there have been times when I've been digging for things to talk about, just trying to round out a discussion, trying to make sense of the week. I've had my cup runneth over with things to talk about, so we're going to try to focus on the key things. If there's any silver lining, I would say it's the rally into the close today. So we were a lot worse earlier in the day. The S&P got down in the 2850s. But didn't get much lower than that. S&P finishing down 83 basis points or 0.83%, which isn't bad. It's one of the better days this week for sure. The NASDAQ actually finished in the black, actually got back to the positive, and the NASDAQ 100 was one of the most positive, up almost 1/3%. Mid caps and small caps down much, much more. So it was large mega cap technology that really saved the day here and prevented a much weaker close here on Friday. We were pretty much toward the lows of the day about 30 minutes ago, but rallied pretty good into the close. And again, what that last 30 minutes a lot of times will tell you is where big institutions are rotating. Could indicate some better buying going into the close, which certainly would be a welcome change from what we've seen so far. The sell-off this week has pushed the VIX now above 40. It was up a little further, up in the 43 range, I want to say, when I looked earlier, but still finished up above 40.76, which is certainly a long-term high. The VIX has gotten much more elevated in previous down cycles, so don't think that that's crazy unusual. It just feels unusual for where we're at right now. So let's look at a chart of the S&P 500, just try to make sense of today's trading, how it fits into the big picture. In a little bit when we wrap the week, we're going to look at some longer term charts, but let's just think about the short term chart. So this week pushed the S&P down about 16% at the lows, although today we actually rallied. So we were able to see some accumulation, finishing much more toward the highs of the day, with the S&P around 2954. So that certainly is a more encouraging one-day bar than we've seen in about 7 or 8 sessions, which is good. If you look at where the low was today, again, we always talk about lines in the sand. I thought it was really interesting. A number of these days have lined up with some really key support levels. I don't think that's a surprise or that's unusual. So if you look earlier in the week, I think this was Monday's session, we had that first big gap down Monday. We hit the lows almost to the tick from the beginning of January and the end of January. That's kind of where we ended Monday. That when we followed through there's when it was concerned that this could be a much deeper correction, which we've certainly gotten. Today's intraday low lines up almost perfectly with the low from the beginning of October. And when we talked yesterday and earlier, when we saw the big sell-off started breaking through support, sort of told you the next big line in the sand was that 28.25 to 28.50 range. That's the lows from August. Lows from October, we sort of penetrated that upper end of that range and then rallied pretty good. So at this point, certainly feels like that's a support level to pay attention to. The S&P today, extremely oversold, so with an RSI below 20. That does not happen that often. And actually, we're going to go back just a little bit, keep it as a daily chart, but go back a number of years to find previous times when the RSI has become extremely oversold or with an RSI below 20, and you can see that's actually happened very rarely looking at the last 5 years. Now, granted, this has been, arguably a secular bull market undeniably, but in the most parts, a cyclical bull market as well. So it's been strength within strength. So you're not going to have it become oversold very often. The couple times that happened was the Christmas Eve low here, end of 2018. That was this low here. It also happened in October. So this is that first move down. We sort of bounced up and then went to new lows. And I think a lot of people will be looking at that sort of fourth quarter of 2018 as a potential early parallel to what we're seeing now. I don't know if that's going to be that far off. That might actually be a really interesting historical relationship. Before that, you'd have to look back to mid-2015. And this is the August low that we saw there. So each one of those times when we become extremely oversold, we've rallied, but in both instances in the last 5 years, we've at least gone to a lower low before the bottoming process has completed. So for what it's worth, that's the historical frame of reference we can start to look at. I want to go dig a little bit more into some of the longer term things, but I'd love to just finish on what happened today and just make sense of it. If you look at the fixed income markets, there was certainly a flight to safety that's continued. This has been the last couple of days. The TLT has been strengthening as people have rotated away from risky assets and been more risk averse. Gold had done well, but actually suffered. We'll see that in a minute. But bonds up a little bit, the dollar weakening a little bit, but overall U.S. markets holding up relative to global markets okay. Commodities down even further, and yesterday we saw gold hold up okay, but gold even followed the way down. So oil, gold, both down in a pretty major way. Interesting to see energy at the top of the list, right? Even with oil weakening, you saw energy strengthening, followed by technology, and I think that large cap tech trade is what sort of saved the day here, followed by communication services, which also finished in the positives. On the downside, you had utilities, real estate, and you had financials. So, some of the defensive sectors makes a ton of sense, but you also have financials down there. And again, obviously with a week like this, it's all about expectations. And in our mailbag segment, I'm going to answer some of your questions about what this means in the reaction to the coronavirus and all of that. But I would say it's all, my short answer is it's all about expectations. We don't have time to go through all the stocks that are up and down, but part of my process is every weekend to try and go through the entire S&P 500, look for some of the patterns. I don't know what your process is, but I hope there's something kind of like that in there so you can try to digest what's happened, especially after a week like this. I would just point out a couple things to note. Tickers like Qualcomm are showing bullish engulfing patterns. Bullish engulfing patterns tend to be bottoming patterns. That tends to be a short-term, one down bar and then an up bar where the gap between open and close engulfs the first day's trading. Qualcomm became oversold and a bullish engulfing patterns. That usually means the next couple bars are going to be a little bit higher. So it could signal stocks like that are able to hold. It could be a nice bounce going into next week. Again, we have the weekend where a lot of news could come out, which could cloud the picture there just a little bit. So some interesting charts that are on there. I'd look for some of those engulfing patterns and where they're playing out. We need to go to our next segment, though, which is Wrap the Week. And when we wrap the week, what I like to do is start with the Mindful Investor Live chart list. This is a chart list that I look at. This is part of my weekly routine. But before we get there, sorry, I did want to mention a poll. We have polls going on our channel all the time. So anytime we bring up the StockCharts TV page, you're going to see a poll. I'd encourage you to participate. It's one of the things that allows us to gather some feedback from you, but also gather some insights about what you're seeing and what you're hearing. Helps us to think about these shows. And one of the questions we asked you was about real estate. Is it a good or bad time to invest in real estate? 40% of you said good time, 26% said bad, 35% neutral. It'd be interesting to see how those answers evolved over time as the market sort of sold off, because it probably seems like more and more of a better opportunity just to diversify away from sort of risk-on equities. But interesting that 40% of you say it's a good time. Real estate is one of those asset classes that historically has been relatively inaccessible to individual investors. It's become much, much more so. So with ETFs like the IYR, with the XLRE, the S&P sector SPDR, there are plenty of ways to get exposure to REIT and real estate based things. We talked with David Auerbach from REITbeat not too long ago at the Money Show in Orlando. Had some great discussions about real estate. We'll hope to have him back on the channel soon. Let's get to our weekly wrap, sort of building on that defensive theme and going to the Mindful Investor Live chart list. If you don't have this, just go to my page, go to the Mindful Investor blog. To get there, go to articles, click on Mindful Investor, and you'll see a link at the very top to copy this chart list to your own account. So please feel free to do that. And again, I hope this is not the last thing that you look at, but hopefully it gives you a starting point to build your own routine. This is part of the weekly routine I like to do. And I like to start with a long-term weekly chart of the S&P. This is a market trend model that I started following years ago, and it's doing the difference between the 21 and 34-week exponential moving averages. This does not give a lot of signals. It's going to stay positive most of the time. The only times in the last 5 years it's turned negative was here toward the end in the fourth quarter of 2018 and here in mid-2015. Those are the last two times it's turned negative. It is still positive because one big down week is not going to trigger it because it's based on longer term moving averages. It's tried to minimize the noise, and we're in a pretty bullish pattern because it's been in a long uptrend. So from that trend following perspective, it's going to take a lot more time for it to roll over and trigger. But overall, it still remained positive. What is more concerning for me on this chart is the weekly MACD or the weekly PPO. Similar, very, very similar signals and same signals, just a little different calculation. And what this has done is this week, now locking in the weekly close has given a bearish signal. This is more the tactical read on the S&P from what I found. So it turned negative here in the second quarter of 2019 when we had a pullback there. Turned negative again going into end of July into August, sort of identifying this short-term corrective pattern, and now once again has triggered. What's interesting is you look at how elevated it had been. It looks a lot like the beginning of 2018. 2018, after that initial big down move, became more of a time correction than a price correction. Like that was it. We didn't go lower than that for a while and ended up making new highs. I'm not sure what's going to happen here. That is one way that it can play out. The other thing is a deeper price correction, which is what we saw in the fourth quarter of 2018. So it's too early to say which one of those it would be, but it is telling you we're in a corrective mode according to that weekly MACD, weekly PPO. This next chart is the breadth by cap tiers. We refer to this often, and I color code this over the weekend, and as a quick foreshadowing, I will most likely be putting all these in the red. We had the large cap breadth in green because it had been making higher highs. Now it's gone to a new swing low, and the sell-off this week has certainly indicated the distribution, and that's what that cumulative advanced decline line is now recognizing. We had seen that earlier, though, with a bearish divergence with the small cap. So small cap breadth had already been getting worse and started breaking down earlier this week before large cap. So all four of these, I would argue, now in more of a negative territory to a new swing low. So until you see some sort of bottoming sign, a higher low of some sort, this is going to be a negative read from breadth. So we're going to switch that going into next week. Here we're looking at breadth in the form of new highs and new lows. And again, we have a lot of new lows. We had very few, especially on the S&P. But if you look this week, every day, every session, an increasing number of S&P names making a new low. This is not updated yet through today. We've got to sort of finish the closing process and see where things play out. But as of yesterday, 86 out of 500 stocks had been at a new low. It's about 17% or so of the S&P names yesterday. As of today, I think that number is going to increase a lot. What you have to remember with any one of these charts, I just want to show you this very quickly, is it's very easy to just get caught up in the last 1 year and think, okay, this is an extreme reading. And if your window is only 1 year, I think you're going to get a very skewed perception about what is happening this week. Remember, this week is unusual if you look at just the last year or even the last couple years. You have to go much, much further back. So I would encourage you when you're looking at charts now is start to look at longer term charts and see where these levels relate to other previous sell-offs. Because now what you want to think about is how does this sell-off relate to the end of 2018? That's the most recent really painful market move that we had. How does that relate back to the beginning of 2018? You can see already we've well eclipsed the new lows. Most stocks were actually still not making new lows there. All of a sudden here we're seeing a much more of a downturn. Many stocks making new 52-week lows. This is starting to look a little more like the beginning of 2016 or mid 2015, the beginning of that cyclical bear pattern where we broke to a new market low, real capitulation. We rallied back into resistance before making a new low. And I think a lot of people will be seeing it does now relate back to that 2015 period. I think this is one where you'll be able to make that decision. So we'll have to see how many new lows we were able to print today, but I would be looking back to the left on a 5-year plus chart to sort of see how this relates to some of the longer term bottoming patterns. Other things to highlight, this is another one I want to just focus on very quickly. This is the percent of S&P stocks above their 50-day or above their 200-day. We talked about that 50% level being a really important level because any short-term pullbacks have sort of ended there. So if you look at the beginning of 2018 in January, we bottomed out around 55%. Here we bottomed out around 50 a number of times. When we finally broke below it in October, that was telling you it was going to be more of a deeper decline. We've already now broken below that 50% level, which again, from my read, puts this more within the context of some of the deeper corrections. It's not sort of the garden variety pullback to support. I think we're in a different realm there. What's very interesting is only 7% of the S&P remaining above its 50-day moving average. All the sectors now back below there. So, again, in the short term, it's putting us back into those real extreme blowout lows that we've seen historically. Boy, I feel like a wrap of the week could be an entire hour, if not an entire day's worth of digestion. So we just got through a couple of those charts right now in our wrap of the week segment. I would encourage you to download this Mindful Investor Live chart list. Start where we just did, but go through the entire list and try to get a little deeper at it. I would also point out now is a really good time to look at the scooter rankings. And just to finish up our segment here, look at the scooter reports, look at the large cap stocks, and look at the top rated names. This is a percentile rating. So anything in the 90 plus percentile is holding up okay relative to all the other stocks out there in the large cap universe. So look there for some of the stocks that are actually holding up okay, trying to find support as opposed to the ones that are really getting blown out to new lows. We're going to take a quick commercial break. We're going to be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Welcome back to the show. Thanks for joining us on the Final Bar every weekday after the close. We're going to open the Final Bar mailbag in a moment. I just wanted to remind you, every one of these questions came from you in the last 24 to 48 hours, so please keep your questions coming. The Final Bar at StockCharts.com is the best way to get them to us. You can also go to our Twitter feed at FinalBarSCTV, or during the show, just put a question in the Q&A panel. We're going to get to it as soon as we can. So let's open up the mailbag, answer some of your questions. First off, any theories as to why it took this long for the coronavirus effect to take hold? That's a fantastic question. And what I love about our chat room is someone actually responded in the chat room, which isn't a bad answer, to be honest. It's not the virus, it's supply chains And that's the thing. And so I would say that's partially how I would answer that as well. The market is all about expectations. It's not about what has happened. It's about people's expectations of what might happen. And that's what is priced into the market. So reality is not priced in. It's our expectations of a future reality. So when we don't think the coronavirus impact is going to be that dramatic, the market does not sell off that bad. And that's why when this happened, we were sort of going up and to the right and still kind of holding up okay. And the question was, wow, is that it? I mean, that was it. It's just going to be fine. We're going to get over it. Once things start to feel a little more real, that's when people start to vote with their emotions. And again, the sell-off that we saw this week was a lot of fear that, that sort of became rampant. Again, just anecdotally, one of the high schools in the Seattle area closed because of speculation of a coronavirus issue, and that alone got a lot of people talking about, well, what would happen, and et cetera, et cetera. So that all of a sudden makes it feel a lot more real as an investor, because then you start to think, okay, man, what would actually happen in a wider outbreak or something like that? So it's not about the reality, it's all about the expectations. So I think this week tells you that people have gotten much more nervous as we've seen evidence of the coronavirus spreading and speculation about, and really it's the uncertainty. It's not, the VIX spiking is not telling you that the market's going down. It's just uncertainty, and that is certainly what it feels like here. The supply chain, I think, is the other part of that. And again, even if the coronavirus ends today, and even if we don't have another outbreak, another, that's it, we've hit the limit and everyone starts getting better, it's still going to take quite a lot of time to work through the issues that have been created just on the couple weeks so far. So again, a lot of industries shutting down, cities shutting down, and that'll take time to recover. So the recovery process, I think, is what's going to take a lot longer than people realize. And I think what concerns me about the market just turning left and going right back to its previous highs, which I would not expect to happen, is because the reality is going to set in. Even if it doesn't get worse, and even if here in the United States it's limited in terms of its impact on our day-to-day lives, the time it might take for the supply chains to recover and all those industries to kind of get back up and running could take more time than we know. It's uncertain. So I think those are the real issues. It's all about expectations. So great question, and a valid question right about now. Second question, can a stock have increasing accumulation and increasing money flow and still be declining? And thanks so much for sending a chart. I hope you don't mind me showing it on the air, but it was beautifully done and nice colors and everything. I thought it was gorgeous. So I wanted to show it to you, and I think you're hitting this part in the middle. Price is declining, and doesn't matter what ticker this is. This is an ultra-short industrials ETF, but could be anything. How can the price be going down, but the accumulation distribution, the check and money flow going up? How is that even possible? So it gets to how these sort of indicators are created, and that can certainly happen. If you're not familiar with accumulation distribution, it's no problem. Search for accumulation distribution, or go to our chart school, and you're going to find this article. Both of these are based on the work of Mark Chaikin, who's a fantastic contributor. One of his analysts, Dan Russo, does one of our opening bell shows, which is really, really well done. And it'll show you exactly what the calculation is. You'll see that it's based on where we're closing relative to a range, and it's also involving the volume for that period. So if you have a stretch where there is a down move, but the volume on the up moves is much stronger, you're going to have that divergence where the price is going down and the accumulation distribution can go higher. Same thing with the Chaikin money flow. Because it's based on volume on particular periods, that relationship could be a little disjointed. And I think that's part of where the signal is. When you see, in general, something should be going up and the accumulation distribution should be positive, that makes sense. But it only makes sense if there's much stronger volume on the up bars. Sometimes you'll have the opposite, where a thing can rally, the accumulation distribution can go down because the volume on those down days is stronger, and so as a result, you'll get that divergence there. So it is certainly mathematically possible. It is not usual, and usually you'll see them move together, but when there's that divergence, a lot of times that's where some of the best signal can be. So great question on that, and that is why. If you're not familiar with those indicators, go to our chart school page. We fill in a lot of the details on that. How can you see year-to-date performance? That's a decent question. A couple things you could do. Easiest way I would do it is go to Charts and Tools, go to our perf charts, which is right here, and if you type in a ticker, it's going to give you a performance chart. And what you do is you right-click over here where it has the number of days. You can actually like click and drag this and do some really, pretty stuff, making the chart look different. But if you right-click, year-to-date is one of the standard options that'll quickly do it. That's the easiest way to see a snapshot year-to-date return of anything. You can put multiple tickers, just separate them by commas, and you can put them on there. Also under predefined groups, you can see something like sector ETFs, and we'll automatically feed those tickers in there and just right-click to change the time frame. But the perf chart system is actually really easy way to look some of that up. Man, the mailbag always goes so quickly, and I love answering your questions, so I'll do one more. What about the XLC? When Julius de Kempener was on the show this week, you asked him, the XLC is very new. That's the Communication Services ETF. Is it valid to compare its small data history on seasonality with the other 10? Oh, that's a really good question. So yeah, with the S&P sectors, there are 11 S&P sectors. There have been changes recently. So Communication Services was formed not too long ago, and it took a little bit of discretionary, a little bit of tech, a little bit of the old telecom group, and turned it into one XLC Communication Services. So the S&P, which is what makes that index, actually we can backdate the index going back much further. So we've backdated the XLC to sort of mirror the performance. So it's sort of a theoretical XLC going back. So we can use the tickers that make it up and sort of backdated, which is the easiest way to do it. So we have a decent long-term history of the XLC because it's based on the companies that sort of make that up. So what that does mean is if you go back 10 years and you're looking at it, it might include, it's a little kludgy because you're kind of double counting, you're incorporating some telecom stocks into communication services. But if you want to get a long-term trend on how those stocks have performed, you can easily do it using the XLC. Those are fantastic questions. Thank you all so much. And again, I'd encourage you to send, there are no bad questions, and we'd love to get to them as much as possible. So shoot them to us via email. We need to wrap up the show, folks, and that means it's time for the 3 in 3 at the end of every show. 3 charts in 3 minutes. If these aren't on your radar yet, I hope they are as of this moment. So chart number 1 is Apple. We're going to kind of go micro to macro today. So chart number 1 is Apple. I'm looking at this because it's one of the more widely held names, widely followed names, very liquid names, and it's a big benchmark name. So this is a stock that big money managers have had to own because it's been such a strong relative performer, and it's such a big cap, which means you have to own it if you have any prayer of outperforming the S&P 500. In the last week, though, and really, if you look at the relative performance, it plateaued and started to come off even before the dramatic sell-off of this week. And that tells you that institutions may be starting to unwind a little bit, rotate to other places, get a little more defensive. That certainly has capitulated. I think what's really interesting is even though we gapped down and Apple got down to the 250 handle or 255 or so, we rallied up and closed more toward the highs today. And on a closing basis, didn't come off that much. It's almost flat from Thursday to Friday's session. So it's holding up okay. And on a closing basis now has not gotten below the first Fibonacci support level. So in terms of a line in the sand for something like Apple, it's now traded below the first Fibonacci support, but closed back above. It was oversold here and still is, but overall, not too bad. This could be an interesting place for something like Apple to hold. This is one of the charts I'll be looking at going into next week to see if we get any sort of recovery. And if so, maybe tech is going to hold in a little better than we might have expected. That leads us to chart number 2, which is the XLK. And again, when we sell off, it's much easier to look at things like Fibonacci retracements, which are based on a trading range. Now we can look at the XLK back to the market low in 2019, take it to the peak we saw a week and a half ago, and now see that we're about a 38.2% retracement, right back retracing those that uptrend. So this is the uptrend for over a year, 14, 15 months. We then unwound about a third of that, over a third of that, just in a week, but now we've found support at the 200-day, so it opened and traded intraday right to the 200-day moving average, closed back above the 38.2% level. So again, all else being equal, that's kind of the place where you tend to see things bottom out. You tend to see some short-term support at a place like that. And the question is now, is it the dead cat bounce, sort of quick rebound before a next leg down? Or is this a bottoming process? I can't imagine that we would have a steep sell-off followed by a steep appreciation back to the previous highs. That's so rare. It's silly to think that would happen. Much more likely, much more probable, it's a bottoming process, at which point you see a nice rally and it's going to be the next low. Is it a higher low or a lower low? And that's what I'm looking at with the XLK. And our third chart to finish up are 3 and 3. Is the S&P using this breadth, using the 50 and 200-day moving averages? Only a third of the S&P names remain above their 200-day moving average, and that is pretty rare. That suggests this is not a quick decline. This is going to be more of a process. It's going to take more time and most likely more lows than what we've seen. And if you look, only 7% of the S&P remaining above their 50-day moving average, which looks a lot like mid-2015, which was the beginning of deeper lows. So ladies and gentlemen, that is our show, and that's a week for the final bar. I want to thank you for joining us every weekday after the close. We're very excited to dig into things next week, sort of continue to process this bearish move that we saw this week. Have a great weekend. Please keep your questions, your feedback coming. The final bar at StockCharts.com. And folks, have a great weekend.